Pathway to Success, the course aimed at building a thriving mindset and providing essential tools for achieving your goals in personal finance, presented by the professionals at KVR Team. This course is designed by a financial professional. However, it is meant to be used as an educational resource only. It includes vital information about very critical factors which can determine our level of failure or success in reaching financial goals. It also provides tools and strategies that can help you put money to work instead of always working for money. The following information is not intended to be considered as accounting, investment, tax, legal, or financial advice and should not be taken as such for any particular individual. Please consult with a licensed professional for specialized advice and to build your financial plan. Investments, currency, and stores of value. The world of investments offers many choices. They range from paper assets to real estate and beyond. Identify your areas of interest and work with qualified advisors and mentors who can help you design and reach your goals. No one is more interested in your financial future than you are. You must become self-educated while taking immediate action at the same time. There are 3 ways investment accounts perform in connection with financial products. Fixed. This type of account has a guaranteed interest rate, but moderate growth. Variable. This type of account is connected with the performance of a market index, which means it can have a much higher growth. It can also potentially lose value. This is how the vast majority of accounts that deal with the market work. This type of account has a higher growth potential than a fixed account. It tracks the performance of indexes such as the S&P 500. Variable accounts carry the risk of loss of your entire investment. The third type of account, index, provides the ability to gain alongside a number of market indexes up to what is called a cap. They also shield account owners from negative performance or losses in the market value with what is called a floor. Index accounts are utilized in various insurance and other financial products. Paper assets. Paper assets include stocks, bonds, exchange-traded funds, mutual funds, real estate investment trusts, unit investment trusts, fractional art shares, and other financial instruments, which are bought and sold in our capital markets and traded on our exchanges. Our capital markets are made up of organizations and financial institutions which promote the trading of paper, real estate, commodity, and other assets, then track their value, which can go up and down. One of the most popular indicators of the U.S. economy is called the S&P 500, Standard & Poor's. It is an evaluator of the 500 largest companies in the U.S. and measures roughly 70% of America's stock value. Here is a basic list and summary of some types of paper assets that are available in the marketplace. Stocks are pieces of ownership in a company. They come in several different types. Some give you partial ownership in a company and nothing more. Other types pay what is called a dividend. This is a payment to stockholders from company profits. According to economictimes.com, over long periods, stocks have provided a higher return on investment than any other asset class. However, past performance is no guarantee of future results. Bonds. Bonds represent money someone has invested in a company or other entity. There is an agreement to allow the bond issuer to use that money for a certain amount of time. Then the money is returned along with an interest payment to the bondholder. The bonds issued by companies are called corporate bonds. Those issued by cities are called municipal bonds. Municipal bonds have certain tax advantages. There are different ratings for bonds, which help investors understand the amount of risk they are taking on. Options. According to Investopedia, options are contracts that give the holder of those contracts the right, but not a requirement to buy or sell the asset it is attached to for a set price on or before a certain date. People use options for income, to take a risk in the market for a gain, speculate, and to protect against losses. Options are called derivatives because they get their value from the assets they are attached to. A stock option, for instance, usually represents 100 shares of the stock it is attached to. But options can be written on any sort of underlying asset, from currencies to bonds to commodities. These include U.S. Treasury bills, bank CDs, commercial paper, and other debt instruments. Mutual funds. These are bundles of company holdings that are made up of fractions of shares of each company. This lowers the price of each stock in the fund and makes it much easier for the general public to get into the stock market. There are many types of mutual funds, with many different investment objectives. They are usually run by a professional fund manager who makes decisions for the fund based on those objectives. Some advantages are professional management. Money managers work to get the best performance for a fund's specific objective and increase the value of the fund. Liquidity. You can buy and sell easily. Diversification. This is having your money spread out over many different stocks, bonds, and other assets with the idea of reducing the risk of loss. Low minimum investment. You can start with as little as $10 in many funds. Easy to set up. Steady and even ongoing investments are made simple through the use of checking account drafting to buy into a mutual fund. Some disadvantages are you can lose money. There may be fees that could reduce your return. There are two ways that paper assets can be managed. The first is passive management. This is when your money is used to buy and hold certain funds in the market. The main goal here is to follow one of the main indicators of the economy, such as the S&P 500, and keep that money invested for several years at minimum. The second is called active management. This involves several styles, but the main idea is the firm investing the money has a goal of getting the maximum return by planned buying and selling. Institutional investing. The game that banks play. Banks play by a completely different set of investing rules than most everyone else does. They invest in ways that allow them to make money in all market conditions. First, they are able to invest in companies through the primary market before the general public can. This is typically the initial price offering that is announced when a company decides to go public. Then banks offer these stocks to people in what is called the secondary market, what you and I know as the stock market. They make money from the sale of their investments on the stock exchange, then continue to buy more stocks in large bunches. This drives prices up. Banks wait for demand to peak as everyone else jumps in, and then they sell while the price is high. When investments lose value, untrained people tend to panic and sell too late, creating more losses. When prices hit a low point, the banks swoop in and buy again at a big discount, and the banks repeat this for as many investments as possible, while a regular investor just hopes for a solid return. Banks and other financial firms have specialized computer software and utilize their relationships with people in the market through their investment staff for the best possible information. Firms are also using something called tail hedging. This method can make gains even when the market goes down, with a specially placed and timed use of options. Now, there are more active management firms using the same investment concepts and software. Now, people with modest incomes can gain access to these firms and make this method work for them also. All investments carry some form of risk, including possible loss of money you put in, your principal. Gather more information on this type of investing, and if you feel this is something you want to make a part of your plan, talk with a financial professional who knows about these strategies so they can help you. Precious metals and other commodities. You can invest in gold, silver, oil, diamonds, and other natural resources. Through history, they have only increased in value, but this is no promise of how they will do in the future. You can buy precious metals and stones and hold them yourself in a safe place, or have a clearinghouse hold them securely. Oil and other valuable investments can be purchased in a number of ways, including direct ownership and in a shared format like mutual funds. Commodities futures. Futures are an agreement to buy and sell an item of value, such as oil, steel, and sugar at a specific date in the future. This gives buyers assurances that the price won't go up, and sellers know that it won't go down. The futures market is largely unnoticed by the public. It is for people who want another choice for investing and the potential to make more money. There are several firms that handle futures. Make sure you research and educate yourself properly before investing. Forex. This stands for the foreign exchange market. It is a global market for trading the world's currencies. It is not controlled by any one country. It determines the value a certain country's currency has when exchanging it for another country's currency. People can buy and sell on Forex, much the same as in the stock or futures market. With over $6 trillion moving through it every day, this market has the largest value in the world. It also allows you to leverage, boost your buying power by using loans, up to 50 times the original amount of money you put in compared to just 2 to 1 in the stock market for a margin account. This means you can turn an investment into a much larger amount very quickly if you are with a broker that knows what they are doing, or you yourself understand trading on this platform. Keep in mind, the risk of loss is also magnified in the same way. The majority of people are only focused on the stock market, but it takes 8 months for it to trade the value Forex trades in 1 day. Consider learning how to make the Forex market a part of your plan as you work towards becoming financially free. Cryptocurrencies. Cryptocurrencies, mankind's money, are all digital means of exchange that are encrypted, meaning secured against improper use or theft. The encryption technology safeguards both the exchange and the mining of new coins. Many cryptocurrencies work with a distributed ledger technology called blockchain. This is a public financial database that holds the information on every transaction. They operate independently of any central banks. These are legitimate, real currencies going by names such as Bitcoin and Ethereum. They are created and exchanged by people all over the world without government intrusion. Cryptocurrencies let people buy and sell to one another all around the world without having to deal with the money of the countries in which they live. Bitcoin is the most popular, but now there are over 6,000 variations of coins in the cryptocurrency market. Many countries have allowed their use in trade. Some have banned them. In the US, their use is allowed, and they are taxed as property. This means that when bought or sold, capital gains tax is applied rather than income tax. Buying and selling with cryptocurrencies can be difficult to track and offer anonymity. This has governments concerned about possible tax evasion, as well as money laundering and loss of financial control. There have also been concerns of fake coins and exchanges, as well as other fraudulent and criminal activities related to the use of cryptocurrencies. However, it is fairly easy to make sure a coin or exchange is real with today's verification measures. Cryptocurrencies are a way to exchange goods and services that have many benefits and some challenges as well. Please be sure to have a solid understanding of them before you invest in any version. In summary, having a grasp of how markets work gives you a chance to use them to create a sizable income for yourself. When you are ready to invest, search for people who are focused on making money in every market condition, or at least know of ways to minimize losses. You must understand their recommendations and those of any professionals you work with in order to become truly empowered. Also, if an advisor tells you that a certain investment is a good idea, they should be invested in it themselves, personally, to show their belief in it. All investments carry some form of risk, including possible loss of the money you put in to start with. Talk with a financial professional to help you with your plan. But do not place your future in anyone's hands. Get involved and be in the driver's seat. It's your destination. Thank you for watching our educational video. For more information, visit kvrteam.com.